Hey everybody, Joe here. Welcome to another Finance in 15 here with my partners Josh and Melissa. And boy, has it been an exciting couple of months here. So we are going to go through the indexes and the major markets, what's going on with these indicators and some major economic trends, and then what are the implications for you, the investor, and for us, your planners, as we put together these financial plans for you. So without wasting too much time, let's go into the indexes. So over the past year, we've seen the S&P 500, which makes up the 500 largest U.S. companies, has been up 27, a little bit over 27.5%. So we've seen a huge rally in the fourth quarter, continuing into the first quarter of 2024 and 2023. Also, we've seen reasonable performance out of the non-U.S. stocks. So the MSCI EFA is U.S. or non-U.S. and non-Canada stocks, and they've performed about 15%, so comparable returns. And then we have seen a drawback or a reasonable back to reality return of the aggregate bond index that represents the U.S. bond market, and that's returned about 4%. Josh is going to get into a little bit more of the fixed income for us and some of the indicators that we're seeing with that. Very briefly, we wanted to touch on some sector performance. So what we can see over the past year, and this is a pretty busy graph, but this shows you all the sectors of the U.S. economy. And what you can see is that the technology and communication sectors have kind of outperformed. We've heard some talk about the Magnificent Seven and these 7 tech companies that have really driven returns within the S&P 500, and this chart's kind of showing you where returns have been concentrated. But the good news is that all with the exception of the utilities market, all the major U.S. sectors have had positive year-over-year returns, which kind of has brought some talk about a soft landing up. So, Josh, we've heard a lot of talk about the Federal Reserve, interest rates and such over the past year or two, as the Federal Reserve had to increase rates to slow down the economy and now potentially cutting back rates. So what's going on with this interest rate policy and why is it important to us?
Oh boy. This might be finance in 150 minutes, but I think we need to take a couple steps back. And first, first thing is to recognize that for the last 2 years or so, we've spent more time talking about Fed policy and the importance of that, in particular to the overall economy and stock market performance, than we have in a long, long time, right? I mean, prior to...
Maybe even ever.
Yeah.
I mean, there's been more discussion about that over the last 2 years than in the last 10 years.
And for many reasons, it's because the Fed had a very clear objective prior to this inflation issue that we had coming out of COVID, where it was keep rates low, keep money loose, and everything was rocking and rolling, right? We had one of the longest stock market rallies in modern economics. Mm-hmm. Corporate profitability was productive and more profitable every single quarter and every single year. And for all intents and purposes, it looked pretty honky-dory, right? Then we hit COVID, and a lot of things changed.
But isn't it true, Josh, that there was a significant shift in Fed policy starting after the Great Recession and how they handled things?
Yeah, so the changes that we saw come to light after COVID were really a huge function of why we're feeling the impacts of them now, is because of some significant Fed policy that was changed back post 2008 that really kind of went untalked about, not talked about.
Well, everybody knows what quantitative easing is, but I think a lot of people have forgotten what that is because it's been a long time.
Sure. And if we really go back to the heart of where a lot of these changes were made, it's mostly predicated around how the Fed regulates money in and out of the supply system. And a big tool that they use are banks. And we all kind of know how banks work. We go to a bank, we get a loan. Where that money comes from, maybe it's from the bank reserves, maybe it's from the Fed, maybe it's from other banks. But at the end of the day, the banks create this liquidity to us as consumers, and the Fed uses the banking system as a way to either flood money into the economy or to take money out. Before 2008, they used what they called a scarcity mentality, a scarcity reserve system, a scarce reserve system, where basically, let's say for every $100 I deposit into a bank, the bank would keep $10 of it in its reserves and go ahead and invest the rest. And post 2008, after the major credit crisis we had, the major real estate crisis we had, all the banks failing, the Fed kind of changed their system a bit, and they said, whoa, you guys got to keep way more money in reserves. And now there's about $40 for every $100 in the banking system. And all of that money, even though it's not necessarily in our hands, is partially to blame for the inflation we're feeling now and all the things we felt. And it's really changed the entire landscape of how the Fed manages interest rates. And that's, I think, a big part of what we've been wrestling with now. So, it doesn't get talked about a lot. And any of the implications, I think, that we discuss when it comes to, is the Fed going to raise rates, or are they going to lower rates, and what's the impact of that? How many times we talked about that over the last 2 years, and that is important. And I think we're constantly now like searching for data, like, hey, housing has improved, or the job market has improved. What's that mean for the Fed raising rates? When at the end of the day, the money supply is probably one of the biggest issues that is ultimately going to determine whether or not inflation is going to be okay long term.
Right. So just zooming out a little bit, I mean, I think just fundamentally, the Fed has three major tools in its tool belts to manage monetary policy, to basically either stimulate the economy when it needs a little help or slow it down when it's growing too fast. And those three tools are interest rates, which is what you hear all the time. The less talked about is the money supply, right? How much money is in the system, and then managing their balance sheet. And actually, those are the things that really are the bigger drivers of this inflation. I mean, yes, controlling interest rates helps, but part of this inflation was caused by just too much money being in the system. And until that gets absorbed and that equalizes.
But can it get equalized and absorbed if the banks have so much liquidity?
Well, right. And that's where, going back to 2008 and 9, this abundant reserve versus scarce reserve mentality. The reason there wasn't a lot of inflation in 2008 and 9 is they did the same thing, but they also raised the bank's reserve requirements, so it didn't get circulated in the system. This time it did. But also, even more importantly, this abundant reserve to scarce reserve system actually forced something that was really an efficient market that set the Fed funds rate, where there was sort of this market between banks where they would lend money to each other, and that's what set the Fed funds rate. So it was a more efficient market. That switched to basically the Fed making that decision, not really based on an efficient market figuring it out. And we don't actually know, and nor does anyone know, how that actually is going to impact things overall, which is why there's been a lot of questions. I mean, if you look at a chart and you look at the Fed funds rate post 2008, rate to about the pandemic, you see, and you can actually see from 1960 to now, and then all of a sudden there's this drop, and rates were held really, really low for a long time. There is no other period since 1960 where you actually see that. So rates were kept artificially low for a really long time, and that caused asset classes, in my opinion, to behave in an odd way. It drove bond prices up. But they were eventually, because rates were low, paying very little. So right before the pandemic, you had, fixed income that was overpriced, but maybe paying 2.5%. So that wasn't a very attractive asset class. I mean, it did fuel a lot of growth in the stock market, but part of that behavior from the Fed has impacted asset class behavior, and that's where we did see, post-pandemic in 2022, a big recalibration of all those asset classes as a result of that unraveling. Yeah. In addition to the massive amount of, supply chain damage, money injected into the system to kind of keep things going because of the pandemic after the shutdown that we had, unprecedented levels of government support. So that's just putting more money into the system and keeping interest rates very low for a long time. Yeah. So that's sort of where it all started. So the story didn't start at the pandemic. I think a lot of us think it did. It started back in 2008 and 9. And all of these decisions that the Fed has made and thinking differently have impacted the situation differently.
So Melissa, you had kind of brought up the fact that we were kind of coasting on this low rate, high corporate profitability environment for many years. We saw good stock market returns. Money was easy to get to. People were having good, productive, I think, investing and growth. And then we had COVID, right? And as you had mentioned, we all had mentioned this massive inflow of money into the money supply through PPP and all of the stimulus that the Fed and Congress had generated. And now all of a sudden, we look back and this is obviously not news to anybody. We're in this massive inflationary environment now. And so what does the Fed do? The Fed starts to raise short-term rates. Well, back to what you had said again a moment ago, in the past, although the Fed was responsible for setting rates, there was a secondary market. There was an entire capitalistic type of system that actually set rates. Banks would swap rates back and forth to determine really what was the right interest rate. What's the market rate instead of the Fed deciding.
On an arbitrary.
Arbitrary.
Because it is arbitrary. It's completely arbitrary.
In the abundant reserve system, the Fed shut that down. They literally fired the private market for setting rates and said, we take full control over that. So although they had full control since 2008, their control led them to low rates and good profitability pretty much everywhere. So nobody paid attention to the fact that they were making and calling all the shots because everybody was making money. This was the first time with inflation out of control that the Fed had to make decisions completely on their own that was really impacting people negatively.
Well, and really, they don't really understand the full implications of it. And so some of the things they would normally do, we don't actually know if they'll work the same. And that's been the big concern.
So we saw the fastest and the most highest velocity of rate increases by the Fed in modern economics. And Joe, tell us about that. Like, what did that do to the yield curve? What did that do to everything in terms of the Fed raising short-term interest rates?
Right. And just real briefly, just so we're all on the same page, and I know we talk about this a lot, but when we look at a yield curve, a normal yield curve in a normal economic environment, right, we get paid more to give somebody our money for longer, right? If I give you a 10-year CD. Exactly. I know you love duration, Josh. So in a 10-year CD, I should normally get a higher rate than a 2-year CD. Well, in an inverted yield curve, that is different. My short-term debt is paying me more than my long-term debt, disincentivizing me to go out that yield curve.
Right.
As well, if you're running a business, that hinders you. So what we've seen now, and we don't know if this is going to happen. Let's keep our fingers crossed. Like you said, this is the first time in this experiment in modern economics we've allowed the Fed to do what they do, and they cut rates more severely than they ever have before. However, increase rates. Sorry. So the inflation has subsided. The jobs market has remained strong, and one of the bogeys out there is consumer spending. We saw in the sectors that the consumer discretionary sector has remained stubbornly strong, which we would have expected to see a pullback in that. So time remains to tell us what's going on, and the main thing we want to watch is, do we get ourselves into a recession by having those large rate changes?
Which normally we would.
Most of the times in history, we look back and say, wow, that had to cause a recession to get us back to a more stabilized environment. However, things are looking well. We'll keep our fingers crossed. However, there are a lot of bogeys out there. We have geopolitical tensions in the Middle East. We have geopolitical tensions in Ukraine. And we also have an election year. So we have an election coming up. We wanted to touch on that a little bit because we felt it was important. What were some of the thoughts you guys were having around our upcoming election that you feel our investors should take heed of?
Well, I mean, I certainly think elections are important. For a number of different reasons, just one of them being the economy and the stock market. But I think just from everything we've been talking about, what the Fed's doing in their policy is going to drive all of this way more than the election this year. Presidents do have an influence on some of these decisions, but they don't have all of the influence. That's why we have a checks and balance system in this country. But policy can kind of influence some of these things. But generally, what we find is that there isn't a direct correlation between an election result and the stock market going up or down, or the economy growing or not growing. All of these other things really take precedence over that. And if we look at the data and we forget about all the other reasons we care about who's president, that's actually just the facts.
Well, I think that we hit on a lot of good points today. I want to summarize those. But first, as always, we appreciate you taking time to join us. If you're one of our clients, make sure you're coming in for your annual review meeting so we can check in on your financial plan, your risk tolerance, your allocation, and everything else that goes along with a solid financial plan. And if you're not, we're happy to give you a second opinion. But to summarize our points, guys, there's, as always, a lot going on. We are here to help you, but let's summarize. So one, I think, Melissa, you said this, things are not as bad as they seem, right? There is a lot of positive economic data and things that we should be happy about, but work to be done. Josh, you said this, we are knocking on the door of normalization. So the labor market, the interest rates, the inflation, all these key economic indicators have started to normalize, which is starting to lead us to incline that the FOMC has done their job, that we've given them the power this time. And then lastly, and I think, Melissa, you said this one, but the Federal Reserve is more important than the presidential election to pay attention to from an economic standpoint. Although they're all important, all these things are news and important, take heed of all of them and weigh them appropriately. So very, very good points today, guys. I think they're all really well placed. Any parting thoughts you'd like to leave anybody with? Or
I mean, I think I would just like to say, like, these are very complex issues, and certainly, it's nobody can possibly know how all of this is going to turn out. But we are here for our clients as a sounding board, and part of our job is to help separate out the things that we feel are important and are really going to impact portfolios in our clients' financial situation, and the things that are less important. But if we have clients that are feeling nervous or want to talk, we're here. And I think it's really important for our clients to know that. And that's why we do these things. We do these things to help provide clarity and give you our take on how things are going. So
I agree. Thanks. And I think one other parting note is there's a lot of noise out there right now. A lot of that noise is not necessarily the right narrative, and we really do try to sift through a lot of that for you. So if you have questions, give us a call, talk to us, and hopefully we can at least provide some clarity for you.
We might know a little bit more than Gary at the water cooler, hopefully.
Yeah. Well, thank you guys. Those were great points, and we'll see you next time on Finance in 15.
Thanks, Joe. Thanks.